Good Tuesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Mitra Pargamonic. How you doing, D?
Good morning, Will. How are you?
Good. You want to start with the disclaimer?
Yup. Good. I think you took it down. But while Will's bringing up the disclaimer, everyone keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer. And let me share my screen. If anyone's joining us for the first time, we do this show every morning to answer any questions you may have about Market Chameleon tools, data analytics. We also provide a link to Zoom if you want to come on the show and ask your question. It could be about a strategy even, or something unusual you've seen. Click on that link to Zoom. It takes you, once you get into Zoom, there's a button at the bottom, raise your hand, click on that button. You don't have to turn on your video camera. Once we let you in, everybody could hear you. You could ask your question live, direct. If you prefer to type in your question, you can do that on the live chat on YouTube. Will's watching it. He'll read back any questions that come in. And in the meantime, we're going to give a couple minutes for anybody to put their questions in. We'll start out taking a look at the pre-market report, see what's trading in pre-market hours, if we could get some insights there. If we don't have any questions come in, I'll continue on to another part of the website or try to answer some questions that I typically get, maybe through either email or chat, that I feel if they come up frequently, maybe I'll just discuss those questions. So let's start out with the pre-market report, and if questions come in, let me know. So this pre-market report, these are stocks that are trading in the pre-market hours. We have a list of our most active stocks, our biggest percentage gainers and biggest percentage decliners. Down here, I see 31 stocks made our percentage gainers list, 38 on the decliners. So kind of a neutral bias at the open, neither way here or there. What we can do is filter down this list to a smaller group of stocks, because you could see on this list, there are a lot of small cap stocks, ETFs, leverage products, anything that is listed on a major US exchange. It trades in a pre-market hours and meets our thresholds to make this list. So what we're going to do is narrow down this list to a smaller group of stocks to see if we could get more focused insights. And to do that, I'm going to use this filter here in ETF. Click on that. You get a list of ETFs to choose from. A lot of them are sector ETFs. The top one, that's the broad-based market ETF, SPY. That's S&P 500 ETF. When you click on that, let's do that now. The list below will start getting filtered. Oops. Now let me refresh my screen. I think I had it open too long. One sec, guys. All right, let's do it again. I'm going to click on SPY. The list below got filtered by stocks that are holdings in the SPY ETF, and they're trading in pre-market hours. So these are the S&P 500 constituents. Here we got 4 that made our percentage gainers list, 2 on the decliners. So maybe a slightly bullish bias, but as you can see, not a big list. We have Powell talking today. So he's going to give us their perspective of what they might be seeing now, and maybe a little bit more insights on the projection of inflation, unemployment, interest rates. So that could be something that can move the markets. I think Meta's cutting costs. I think they're laying off more of, I think this is the second time that they're doing major layoffs. So they're definitely, on a cost cutting mission there, but the markets, like that. Not much else from the pre-market perspective. Well, if you have any questions, let me know. I can give it like another minute, maybe navigate to another part of the website. Yeah.
No questions have popped up yet, D.
Okay. All right. So, maybe what I was going to discuss is maybe some of the things that come up, I think, frequently, because we get a wide range of types of traders use our website. There are traders who are very knowledgeable, very advanced. Then we got the middle part, and then we got like people who are finding us that just are starting out. And so from the people who might be just starting out, I get a question that to me is odd, but the question does not seem odd because it comes up a lot. And one of the questions I get, even from friends, maybe Will, you get this too, is people will ask, well, how do I make money? That's a typical question, like, how do I make money? And that might seem not like an odd question, because to most people, because when you look at the world of finance, it's actually pretty comprehensive, involved with lots of we probably have more rules and more intricate, complicated types of instruments than anything in the world, right? And there are people who go to college for finance, they go get masters, get PhDs, go get years of experience and training in banks. And when you, like, if you're sitting at a table, let's just say you're sitting at a table and you saw a doctor, it wouldn't come into your mind to ask the doctor, how do I perform brain surgery? Because you automatically think of it as, well, of course you have to get, you have to get an education, you have to get experience. And even after you do all that and become a doctor, it's not easy to execute. You got to go to work every day. You got to, you have continuing education and all this. And you wouldn't ask a lawyer, how do I just go to court and win cases? Because it involves a lot of work and education, years of experience, but people don't perceive trading that way. They sometimes the questions people ask, the perception must be that it is easy, it is mindless, and it's effortless, and you don't really, like people will say, I think you said this to me, somebody is, what, I don't have time to trade. I'm doing other things and I don't have time to do all this stuff. I just want your best trade once a month.
Yeah. This was the last webinar we did with Felix, and Felix was talking about a few of his different customers. And this was one individual who all he wanted was the best of the best, once a month.
And why I bring this up is that expectation, you're setting yourself up for disaster and disappointment, because it's not realistic. Okay, you're not playing a child's game. It's not a side hustle. You're competing against some of the brightest people in the world, and you could be a very smart person. You could be a doctor and a lawyer, and in your own field you could excel. And I've seen people who were extremely smart but fail in the financial world because really they didn't grasp risk, and there's no formal education. Our education system does not teach risk. It does not teach investment, does not teach trading. You really have to learn it on your own. And I think a lot of people's perception of risk is that, oh yeah, to make money, I have to take risk. And I just take it. And that is gambling, right? So to me, that's just gambling, because you could bet on a football game and that's risk, right? Risk losing or making. You could go to a casino and take risk. So the perception of what is risk to a lot of people is not the same thing to me. Risk is not something, that you just take. Risk is something that you have to analyze. How do you price it? How do you calculate odds? How do you hedge it? How do you map it out? How do you explain it? That's the way I look at risk. It's not just something you take. It's something that you have to really understand and analyze it and explain it, map it out, and be able to price it and trade it. So, the thing is, when you're coming in with the wrong preconceived expectations, you're really just setting yourself up anyway for a disaster. And that's why I bring it out, because it seems, and probably a lot of you heard, well, how do you make money? Like, there's like this easy answer and there's nothing else involved but like a tip. And really, if you want to, a riskless, easy way, you just buy treasury, right? That's what you buy a treasury, that's paying like 4.5% right now, or whatever it is.
That's somewhat new to the marketplace. That hasn't been around since the early 2000s, though, right?
Right. And let me show you guys another thing. I'm going to show you this. And this is what I'm trying to understand right now, because we've been trading, like, really, we started out of college and getting trained professionally. So we might think differently, right? But I'm going to show you kind of like how people think. So let's just say you take a risk asset and you draw a chart, right? And the chart might look, something like this. I'm just going to make it, wavy with whatever path it takes. So, and I've seen these videos. They're like, oh, okay, well, you see, the obvious thing was up here, you should have sold this stock because it's going to go down, obviously. And then down here, obviously, you should have bought this stock and then you should have sold it here. So what does the amateur think is that, well, I have to capture every up move and down move and chase it, right? I got to capture every up move, down move, and chase it. That's how. And that is not, from my perspective in the professional world, that your model would look like, okay? Because there's no way to capture that, because these are just volatility and imbalances moving the stock market around. There's no way to predict that. So your model itself, if you're pricing this asset, has to be much more stable than the markets, okay? The markets are going to be much more volatile than your model that you're trading around. So let me come back here. This was what your model, if you're doing it right, would look something closer to this. And the price is probably trading around. Okay, it should be much more stable, because if you have a model that is this volatile, then it's going to be then it's not like really a great model, right? Your model itself is unstable. So that's number one. And then your model, well, how well do how much do you trust it? Will have a standard error around it, standard deviation, right? So it'll look more like, that's, let's say, your baseline, right? And then it will look something like this. Here's one standard deviation. Or hold on, I clicked on the wrong one. Here's one standard deviation to the upside, right? It should look stable, and here's down. Now, I'm not saying it's not going to shift, right? It's gonna shift, and your model has inputs, right? But it's going to look much more stable than the market. There's no such thing as capturing these peaks, and how far is it deviating, how much trust you put in that model. And your model will have, inputs, variables, to be able to price things out. And then it's going to have sensitivities. If those variables change, how much does that change your pricing model? And it's going to have ways to hedge it and manage risk. It's going to, so when you're looking at it from that perspective, you got to say, how do I create a stable pricing model to explain this asset, to explain the risk, explain, the different inputs, and how do those different inputs, if they change, how does that change my risk? How does that change my pricing? So that's number one. Let me take this out for a second. Okay. You guys, if you read some of the stuff the Federal Reserve does, because the Federal Reserve, they follow models and inputs and stuff. That's a good way to kind of just like start learning about the financial world. Just kind of start reading about, how they break down the different variables, how they create forecasts, how they try to manage, because what they're trying to do is manage the overall economy with unemployment and inflation and so forth. Another thing I'm going to show you guys is, let's say this is the zero line. Let me know if there are questions coming in or people want to move on, but
I will.
So when you look at, when you're trading risky assets that have volatility, right? Well, before I get into that, when you come into getting back to how to this thing, how do I make money? Because this comes up a lot, and if you're a trader, like a real trader, professional, where at least from my background and known many, because most of the people I know are traders, when you come in the morning, that's not really the questions that you ask from day to day. How do I make money? Really, you're asking, you're looking, how do I become a better trader, right? That's what, how do I improve my trading? How do I become a better trader? How do I improve my benchmarks? How do I improve my pricing models? How do I improve my tools for hedging and for managing my risk? How do I improve my execution? How do I, get more market insights? Because those are the things that you will need to become a better trader, to get better outcomes and become more successful. Okay, those are the questions you need to start asking yourself and working on to make yourself a better trader. Because that's how do you become a good doctor? You got to become, you got to do things that make you a better doctor, right? How do you become a successful lawyer? Well, you got to do things that will make you a more successful lawyer, right? And that's how it is with trading. You go asking your questions, how do I improve my trading? How do I become a better trader? What are the things that I could work on today? Should I work on my benchmarks? Should I work on my pricing models? Should I work on my risk management? Should I work on my valuation models? Those are the things that you focus from day to day, trying to fix and tweak and improve your trading. Let me show you how, if you're trading a risky asset, right, you're diversifying, your P&Ls will look something like this. You're going to have, let me do a circle. So you're going to have, losses, like this. and then you're going to have a bunch of, gains. And when you're trading risk assets, there's no way to avoid losses, right? Like people think that they're just going to get gains. There's no way to avoid it. But what is your objective is to get your line. It's going to start looking probably, get your line. It's going to go. Why isn't it? Hold on. You're going to probably start to fluctuate up and down, break around your break even. Now, in the beginning, you're going to have more losses because you're tweaking and you're trying to learn, and it might start going like this, but eventually you want it to start looking more like a ladder climbing like that. That's your objective. So you're not going to avoid these. So what you're trying to do is what? You're always working on, what are you working on? Minimizing these, right? How do I get the variance down and minimize the impact of this, and, maximize this? So what are the benchmarks you're working at? Well, if your expectations, right? Number one, whenever you take on a risk and reward, what do you need to be? Well, your benchmark is number one, the risk-free rate, right? So, the interest rate risk-free rate is always the first benchmark you need to be, right? Because whatever it is right now, let's say 4%, 4.5%. Well, if you could give it 4.5% without any loss, with your principal guaranteed by the U.S. government, a risk-free rate, then there's absolutely no reason for you to take on risk to capital if your reward is less than the risk-free rate. That makes no sense, right? So why would you risk losing capital if your expectation is to make less than the risk-free rate? That would not make sense. So that's your first objective, right? Then your second objective is, if you're taking on risk, what do you think the risk-adjusted rate is? And that's what you have to beat. So that's where your line eventually has to float above, right? And you're looking at, what is this? The volatility of your P&L and minimizing this. So you always have to be looking at this, right? I think people, why am I showing you this, Rebel? Right? This is your risk. People forget about this. People just think, that this doesn't even need to be looked at or analyzed or anything. It's just like something necessary I have to do. And it's something that needs to be, again, analyzed, mapped out, explained, right? And is that risk worth the expected return, right? How do you get that variance down? Can I hedge it? Is it worth taking? How do I manage it? What kind of, if I'm taking, how do I, manage the capital that I should be putting up as a risk? Those are things that you have to look at, because I think that people just really don't understand what risk is, and they just think it's just something. It's just something out there I have to do. I have to take. But that is something that you really have to analyze and understand. So, well, I don't know, if there are any questions. I mean, I don't want to jump back with a couple minutes left.
No, that was perfect, D. I mean, Laurent did bring up something earlier, which was very cool. I think he tends to be short vol. He's been, when the VIX gets to periods where the vol really comes in, he tends to he was talking about taking off his risk, right?
Right.
And volatility has come in, so he's been taking off risk. And, analyzing the risk in any components of your trade is a real big deal. So thanks for bringing that to us.
Yep. Thanks, Laurent. So I guess if there are no questions left, Will. I mean, we could just stop here.
Well, that's good because I have to go blow my nose and clear my throat. I am not feeling well at all today. So awesome job, Diva. Thanks for the thumbs up. And remember everyone to subscribe to MarketChameleon.com, the YouTube channel. Great job, D.
All right. Thanks everyone for joining. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
Trading Peace Chameleons. Great job, D. Bye.
Byron.